Hi, let us do a slightly different video today. Um of course, you know that I'm a finance guy who likes numbers, who likes researching businesses and companies. And I do have my opinion on what constitutes a good company or what constitutes a good business. During my research and analysis, came across one such company listed on the exchanges, which I believe is a good business, is run pretty well, and has the potential to grow even further. So, the company which I'm talking about is a small pharma company called Gujarat Themis Biosyn. It's listed on the Bombay Stock Exchange with a present market cap of about 2,300 odd crores. The current revenue stands at 150 crore with a fantastic PAT margin of close to 33% at 2023 PAT being 50 crores. Um, as of today, it is more or less debt free, minimal a couple of cross debt on the books, uh, no long term loans, and a very healthy cash accrual for the past 3 4 years, ever since it has achieved a certain volume. The company is trading at a P of 44 times against an industry average of 40. Yes, a slight premium. It has a fantastic ROC of 61%, probably one of the best in the industries. It has a long term 5 year sales growth rate of close to 30%. Profit growth rate is even higher. The one indicator where it is very expensive is the price to book value. When the industry is at three and a half times, this company commands a price to book value ratio of close to 12 times. Essentially, everyone is expecting this company to make a lot of money going forward, hence the premium. One key indicator which I really like to track is the inventory turnover ratio. That tells me a lot about how efficiently the production processes are being run and how efficiently the inventory is being managed. This company has a inventory turnover of ratio of slightly above 4 times when the industry average is at about 3.7 3.8 times. So yes, it is more or less at par, but it is managing its inventory slightly better than the industry average. This is as far as the financial indicators go. Uh, Let us have a look at now what kind of balance sheet it has and what kind of profitability numbers it has. If I look at 2023 numbers, as discussed earlier, it had a turnover of 150 crores with a PAT of 50 crores. Uh, Post adjusting for current assets and current liabilities, the changes in current assets and current liabilities, it made a net operational cash flow of 40 crores, which it has utilized in repaying debt about 10 11 crores, which it had in its books, and rest was used to reinvest in expanding facilities. So what is so exciting about this company that I am making this video on the company today? It is not really in its past numbers or its present P number, which of course is at par, more or less at par or slight premium to the industry. It is what the company is planning to do in the next 3 years, which is to expand its facilities by at least 3 times. The company is planning an active investment of close to 200 crores. Let's get into the details. Why this is a business which will give you multi-bagger returns going forward. This is from the credit rating of the company, care, as of September 25th, 2023. What was the most important section of the credit rating was not this, not the credit rating itself or the facilities. It was this section. Was a project execution risk part which uh, the rating agency had pointed out. It says, I'll read from the report. GTBL has undertaken a CapEx wherein it is setting a warehouse and research and development department at its existing plant in Valsad. The total cost of the project is 32 crore, which will be funded through its own funds. However, the company has expanded the scope of the project by adding more fermenters and setting up an API manufacturing unit at its existing plant. The total estimated cost of the project has increased to 183 crores, and the entire project will be funded through internal accruals. Land for same is already in place, and the company has incurred 30 crores towards execution of the project through internal accruals up to June 8, 2023. Uh, Now, my view on this is if somebody is doing an investment of 183 crores, close to 200 crores, uh, my reading of the pharma industry is that it will give us an incremental revenue turnover on an annualized basis of at least 400 crores. Add that to 150 crore present turnover, 400 crore new turnover, and we are looking at a company growing its turnover from current 150 odd crore level straight to about 500 crore level. Keeping the same 30% PAT margin which it currently enjoys, it should make at least 150 crore in PAT in as early as about 3 years' time. Now, a 150 crore PAT with an PE industry PE of close to 40, right, will should give me a market cap of 6,000 crores. Today, the company is available at a market cap of 2,500 crore. 2,500 crore is expected to go to 6,000 crore in a span of 2.5-3 years from today. Now, mind it, this is not an investment advice. This is just my analysis of the company and how the market is going to react. I am not in any way suggesting you go and buy this company, but this is what my reading says, that the market cap of the company will become 3 times within 3 years. So annualized return of close to 65-70% is what one can expect from this company going forward. And this is why I'm saying this is such a good business.